Let's talk a bit more about what's been going on in the markets of late. And joining us now for that conversation is Stuart Kaiser. He is the head of equity derivatives research over at UBS. Stuart, great to talk with you this morning. I'd love to begin in an area that we don't often talk about on this show, but certainly investors are watching quite closely, and that's the VIX and the role that it plays in the market overall, the role it's certainly played during this crisis. And now with the VIX near 20, what is that? I guess that's a level we've been looking at to some extent here. Jared Blickery does the technicals for us at Yahoo Finance. What does that level to you mean about the state of the market as we look out to 2021?
Hey, good morning, and thanks for having me. Look, the VIX getting down to 20, I think, is obviously caught a lot of headlines. I think it reflects, two basic things, frankly. It's just that the market's rallied pretty significantly, and that realized volatility over the last couple of weeks has been quite low. The point we've made, though, is that even though the VIX is at 20, the VIX futures, beyond January are still around 25. So the volatility market, I think, is telling you that, recently we've had very strong market performance, but there's still a lot of underlying risk out there in the market that it's quite aware of and quite sensitive to. And until we, start to see that volatility a little bit further out the curve, so in the 3 to 6 month space, start to come down, I think that means the market is still a little bit on guard. I think the positive side of that is it does suggest that there's still a little bit of risk premium out there in equity markets. So even though markets have rallied, there still could be a risk premium compression, which all else equal would be positive for the performance of the S&P 500, for instance.
And then I guess in thinking about a return to the regime that prevailed, let's call it 2017, 2018, where we had, low double-digit VIX type levels, that was really the defining feature of the market in many ways. What steps would you need to see to start thinking about that as a framework for the market? Because I think right now you still need to be on guard for 2-3% moves either direction.
Yeah, it's a great question. 2017 and 2018, I think were pretty unique from each other as well. 2017 was, I think, one of the lowest volatility years we've had for the S&P 500 in 50 years or so. So I think, getting back to 2017 is going to be a little bit of a heavy lift. 2018 might be the better comparison in the sense that volatility was low, but you still had one or two events where the market drew down pretty considerably because there was a fair amount of uncertainty in the market. And, to some degree, 2021 might feel a little more like 2018, where volatility is declining. In between these sort of quote unquote events, the market behaves very well in low volatility, but you still have some things going on. For us, 2021 at this point, once we get past the Georgia runoff, which the market is pricing as a reasonably sized, political event, we would expect implied volatilities to decline post that event. But still further out, kind of into the second half of 2021, we still think that risk premium or that additional kind of concern for the markets is going to be a little bit sticky. And take a little while to come down, because even though the vaccine has been announced and the efficacy rate was a huge surprise, it still needs to get distributed. It still needs to be taken twice. There's still enough uncertainty out there, that we think risk markets are going to be a little bit cautious, and equity investors, even though they've been very bullish the last couple of months, are still going to be, just a little bit on edge in 2021, given the scar tissue and the muscle memory we've had from what's happened this year. One thing we've been highlighting, for instance, is like 12-month S&P 500 puts. So the cost to hedge yourself out for the next year are still exceptionally high. And that put option would generate you more than twice the S&P 500 dividend yield, for instance. And I think in a nutshell, that shows you that even though things are much better and market dynamics are much improved, the options market is not quite as complacent, perhaps, as the price action at the index level would indicate.
Stuart, should investors expect really wild swings in the S&P 500 once Tesla's added?
Our view is that at the index level, it won't be a huge impact. We went through the process of saying, what would S&P 500 realized volatility have been had Tesla been a member for the last couple of years? And frankly, the impact was, 0.1 vol points. It was a very small impact, and the largest it got was less than one percentage point of volatility. So at the index level, we don't think it's going to be as big an impact on volatility. How it impacts sector or index performance, though, might be different than that. If you look at the consumer discretionary sector, for instance, if you would have had Tesla as a member of that sector this year, that would have had a fairly significant impact on the realized volatility of the sector. It would have increased it by about 1.5 points, and at some points as much as 6 points. And just for reference, that's on a base of about 25. So it could have a very significant impact at the sector level, though we don't expect it at the S&P 500 level to be disruptive from a volatility perspective.
And Stuart, sort of a market mechanics question around Tesla. We keep hearing about how much money is going to move around that rebalancing. I'm curious how much is happening in advance through options, if you're seeing any of that activity on the part of institutions as they set up for that index change.
It's a great question, and I've seen a lot of estimates out there in terms of the rebalancing. I think the positive news is this was pretty well flagged. There was some discussion that Tesla would get added earlier in the year, and they pre-announced the addition this time. So hopefully fund managers have had enough time to at least begin to get themselves rebalanced into it. It's also been a very popular thematic stock. So you may have a lot of investors that have owned this outside of benchmark anyway. So, could it be disruptive a bit? I guess it could be, but I think in this case, the fact that it's so well flagged and this has been such a popular quote unquote theme stock, hopefully it wouldn't be so bad. From an options perspective, all of these large cap tech stocks, whether they be, Google, Amazon, Tesla, Facebook, are very, very popular from an options perspective, both retail accounts as well as institutional accounts. So, you've definitely seen at periods of time a lot of options flows into those stocks. I'm not sure if those are to rebalance or if that is just your sort of natural, high volume, large cap tech stuff we're seeing on the option side. So I think my answer to there would be we've probably seen a bit of it on the option side. I think we've probably seen a significant amount of it on the cash side. And if you put those two things together, hopefully the addition later in December will be, a modest impact as opposed to something that's a little more disruptive, especially since that does get you pretty close to the holiday.